And by the way, the other two, Lizette and Gabriel, you guys good? Can you guys hear me?
Yes.
Yeah, we can hear you.
Okay, great. Thank you, guys. All right, so this week we do shift gears quite a bit. Last couple of weeks we've been looking at interest for the most part. So whether that be simple interest, compound interest, or interest earned on annuities, or interest paid on mortgages, that's really been what we've been looking at for the past couple of weeks. And this week we shift gears because we're focusing on two different things: inventory and depreciation. Now, both of these things tie into a business's financial statements. And so you have every business utilizes three financial statements. It's pretty much worldwide for the most part, but that would be the balance sheet, the income statement, and the statement of cash flows. And these are statements that you will learn a lot about when you take your accounting class. And these two topics that we're going to be looking at really tie right into the accounting portion of this course. And next week, we'll be looking at financial statements as well as doing ratios, which is some of the math to figure out the health of a business. You know, how quickly do they turn their assets into cash, et cetera. So those are things we'll be looking at next week. But this week, I'm kind of getting ahead of myself a little bit because we're talking about inventory and depreciation. Inventory predominantly is affecting your income statement or your overall profit. And then depreciation is more about your balance sheet and that your asset doesn't keep its same value, you know, over time. It depreciates. And so you have to actually depreciate that in your balance sheet. So that way, you know, you have an accurate picture of what your assets really are. And so there's a role for each of these, but they both tie into your financial statements, which we'll be looking at next week. But learning how to calculate inventory and learning how to calculate depreciation, it's not going to matter whether you've been introduced to the balance sheet yet or not, or the income statement yet or not. So I thought I would go ahead and do it this week, and then next week we'll go over what the financial statements are, how to calculate horizontal analysis and vertical analysis on those various financial documents. And it's good for you to know about them. If you've already taken accounting, you're probably going to be, this is going to be an easy week for you. If you've never taken accounting, it might be a little different, but you'll be prepared when you do take accounting because you'll have already been exposed to some of these principles. So the first chapter that I'm going to talk about, of course, is inventory, chapter 16. And I'm going to share my screen. And my hope is to just kind of explain it a bit to you. Let's see, here it is. So that way you can kind of get a picture, an idea, I guess a big picture idea of what inventory is and how it's calculated. And of course, every business has inventory, right? You buy stuff and then you either put it on your shelf to sell to somebody else, or you produce something and you put it in a warehouse to sell, or you even just have things like supplies like pens and ink and tape and all kinds of other stuff that you might use for your business. And that's an inventory, any kind of supplies you have. And so it's important to know that, you know, what the value is of all that stuff, because it's going to dictate what your true profit is. So if you take your revenue that you've earned over a course of time, whether that be a month or a year, that revenue includes valuable items that you still have on your shelf that you have to take out of that revenue, because maybe you've produced a bunch of product and it's in a warehouse, you haven't sold it yet, so you haven't actually gotten the money for it yet. And so all that needs to be considered almost like a cost. We call it cost of goods sold. And that's what it costs for you to sell those items. And so that actually comes out of your revenue, and that's inventory. And so the reason that there's various methods of calculating inventory is it all depends on what you're trying to accomplish. If you want to pay less taxes, or you're not afraid to pay more taxes, or you want to have a higher level of inventory cost or a lower level of inventory cost, all that ties into how you report it and how you calculate it, because it'll all be a little bit different. And the cool thing is, in United States, they actually allow for this. In the international world, they do not allow for it. So you can't do it in different methods in other countries. But in America, we have the freedom to do it. So we might as well take advantage of that, especially if it benefits us tax-wise. So there's many different styles. I think there was 7 different types of inventory that you could do. And we're only going to look at 3 of them, and they're listed here. One of them is called first in, first out inventory. The next one's called last in, first out inventory. And then the final one is the average cost of your inventory. So again, the goal here is to figure out how much inventory you still have left and how much value is there in that inventory. And that's what you're trying to discover in these problems. So if you look at my screen, you guys can see my screen. Yes? It says first in, first out. Are you guys seeing that?
Yeah. Yes.
Okay, so you see the little picture of the truck and the warehouse and all that? Yes?
Yes.
Yeah. So this one here is going to describe first in, first out. And if you kind of get your mind wrapped around this, it'll help you. But you see here a little truck on the left, and it's dropping off items. And if you look in the warehouse, if you look all the way to the right, the number 1 is the little red box, and then the number 2 is the little brown box, and the number 3 is a green one, the number 4 is a brighter red one, the number 5 is blue, meaning that the first box that was put in, that's the first one that was put in, and then the 5th box is the last one being put in, right? So if we're going to say, well, the first one in is the first one out, that means when I sell the first item, it's going to be number 1 that leaves the warehouse, right? That would be my oldest. The one that's been in there the longest is going to be the one that leaves first, right? First in, first out. So everything that is the oldest will be sold, and everything that is the newest will remain, right? And a lot of these questions that we're going to look at are going to ask you not for what was sold, they're going to ask you what is remaining, what is the ending inventory, what do you still have on hand? And that's the key. So when we talk about first in, first out, that means all of the first items I put into my warehouse were the first ones I sold. So what remains is all the oldest or the newest stuff, the stuff I most recently put in to my warehouse. So by date, it's going to be the newest. It's going to be those items that are, again, the last ones I put in. The opposite of that is what we call last in, first out. So if you look at this illustration, here you have the same truck dropping off the same 5 boxes. However, when it comes to selling it, I'm going to sell the last one I put in first. So in other words, box number 5 goes out first. It was the last item I put in first. That I put in, the last item I put in is the first one I sell. Now, the reason that companies do that is because sometimes the last item you put in might have been worth more money. It cost you more. So you're going to pay less on taxes. You're going to show less profit because it costs you more to make that item versus maybe the first one you put in, or vice versa. Maybe the last one cost you a lot less to make. And so therefore your taxes are going to be higher, which you want them to be higher, whatever the outcome is. So you can see here down, there's a little diagram. When costs are rising, FIFO gives you a higher gross profit. When costs are rising, LIFO gives you a lower gross profit. When costs are decreasing, FIFO gives you a lower gross profit, LIFO gives you a higher. So the opposite happens. So that's why you might choose one over the other. Now, like I said, this isn't allowed internationally. This is only allowed in the United States. Most companies only do FIFO.
So I have a question here.
Yes.
According to your slides, what you have taught us, the FIFO, the last one which has gone in has been taken out first in your PowerPoint slides. When you've done the problem, the FIFO inventory evaluation, the last one which came in, that was taken out first according to FIFO, and LIFO, the opposite was done. So is there a mistake there according in the PowerPoint slides and in the textbook? Because that's how.
This is right out of what I'm giving you is right out of the textbook.
Yeah, but this is a PowerPoint slide. Just let me have a look at it 1 minute.
Okay. So back to my back to the diagram here. We had a little not an interruption, but a question. Let me go back to this is the README, by the way, for this week. Hopefully you've read this. So that's FIFO and LIFO, and we'll work a couple problems. And then the last method we're going to look at is called average inventory. In my opinion, this is the average cost method. It's the easiest because all you're doing is taking everything in your inventory and you're dividing it by the total dollar value. And then that's coming out to a per unit cost. And then that per unit cost is multiplied by how many you have left in your inventory. And that's how much value that it has. And that's the easiest. So I'll explain all of these to you here. in just a second. What I'm going to do is, I didn't do it yet, but I'm going to log into Canvas. So I'm going to pause the recording for a second. I'm going to log in with my iPad so that I can, so you can see the first problem, the Best Buy
Yeah.
merchandise.
Yes.
Want to do, is that the one I want to do? I think so. All right, so we're going to do this Best Buy example. This time use the data from Try It exercise 1, page 530, page 538. Okay, whatever it says. So we want to first calculate, oh, this is average cost. Okay, sorry, it's not the right one. Hold on a second. Let me get the right one that I want to use. Right, that's not it. Here it is, right here. Okay. All right, now we're on the right page. All right, so we're going to look at this first problem here. It says you're the merchandise manager at Best Buy. The following data represents your records of the annual inventory figures for a particular video game. Using the FIFO method of inventory pricing, what is the dollar value of the ending inventory? That's the thing you're looking for. If 380 video games were on hand on December 31st, meaning that is my ending inventory. That's what I still have left, correct? So here's the question to ask. If this is first in, first out, that means the items that I first put in were the items that I first sold, and the items that remain are the ones that I put in most recently, right? So if you look at our chart here, we have January 1st, then May 14th, then August 27th, then November 18th. So the items that sold first, that had been in there the longest because they were there first, are the ones that were there on January 1st, and some of the ones that were there on May 14th, and maybe even some of the ones that are there on August 27th. What remains in my inventory then is what was put in last. So those for November 18th and probably even some from August 27th. So kind of keeping that in mind, my ending inventory, I'll just do it EI, and I'm using my finger, so I apologize, 380. And so I'm going to try and figure out how much value is in those particular items. Since 380 remain, if I start at the bottom, the most recent was November 18th. There was how many units? 300 units, correct? So those are still there because it was 380. So 300 units remain, and those were $875 each. This is going to be really hard to do with my finger. All right, but there was 380 units still remaining. So that means of the August 27th, there was also 80 units that were taken from that, and those were $9 each. So we'll do $9. And if I do the math on that, if I do 300 times 875, they came up to 2,625. It's already been done for us at the top. And then the 80 times $9 is $720. That gives me a total remaining balance or total remaining value of $3,345. So that is my ending inventory value right there. I just did it. That means everything above 80 units for August 27th sold. Everything on May 14th sold. Everything that was in there on January 1st all sold. Those are all gone, and what I have left is what I put in last, right? Because what I put in first was sold. So what I have is what remains, and that is 3,345, 380 units valued at $3,345. So that's the answer for FIFO. Now, the next question goes on, using the same data to calculate the value of 300 video games with the ending inventory by using LIFO method. So again, I'm trying to find ending inventory, but this time I'm using LIFO. So that means the last items I put in were the first ones I sold, right? Which means the oldest items that were in the inventory are the ones that are still there. So if I put in November 18th was the last items that I put in, those are the first ones I sold. That means I also sold some of the August 27th ones as well. So what's still there then, the ending inventory, are the oldest items in this case. So what do we have? We have 200 units. That is $8 a unit. So that's still there, but it was how many? 380, right? So then if I go to May 14th, that was 1-1. And then if I go to 3, is that May? No, 5/15. That was the next time they were put in. 514, sorry, here. Erase that. So 514, those are still there as well. And there was 100 of those, and those are times, so let's do times how much?
850.
So those are still there. And then on August 27th, there was more put in, but I need 80 more, right, to keep my 380. There was 380 still remaining. So that means of the 250 units that were put in August 27, all but 80 sold. So I only have 80 left. And then multiply those by $9. And if I do the math on each of these, it gives me 1,600 for the first one. And then 10 times 850 is 850. And then 80 times 900 or $9 is 720. So altogether I have $3,170 in ending inventory. That's how much I still have in there, because the last items were gone first and the oldest items were remaining. So you just got to get your mind wrapped around that concept. And remember, they're asking for ending inventory. I think it would be a lot easier if they asked you how many items were sold. Then you would just go, okay, first ones in were the first ones out, so those sold. But when they say ending inventory, you have to think, well, what's left? And that's where it become a little confusing. So that's the LIFO and FIFO method. Now let me show you the other one, the average inventory. Let me open that sheet up because I think that one, is that the same one? No, that's the one we just, here's the ending inventory one right here. So we'll share that to Easy Teach. All right. Once again, let's use the Best Buy example. This time use the data, try it exercise 1, page 538, same one. Calculate the value of 380 video games in ending inventory by using the average cost method. Now in your formula page, there is the average cost formula, but it basically, I'll just do average cost equals, and I'll put total value divided by the number of units you have in inventory. So in this case, the total value was $7,375 divided by 850 units comes out to $8.62 for each unit. And if I have 380 units left in ending inventory, I would just multiply that by that. And that would give me $3,275.60. It's not letting me do the little dot there. So $3,275.60. That would be my ending inventory value. So I think the average inventory cost is the easiest because you're just basically taking the total amount and you are dividing it by you're dividing it by the number of units, and that's going to give you your total. So let me go ahead and do one more of these with all three. I'll do one more page of this, and I think that's what I was looking at originally right here, these 64 DVD players. So I'll just do one more for the sake of doing it. So in this case, I have Sonic Blu-ray players available for sale. The cost of goods available for sale from the following inventory figures at Superior Electronics. And so we have here, calculate the dollar value of 64 Blu-ray players using the FIFO method, first in, first out. So again, they're looking for the dollar value of the remaining inventory. That's the goal. You got to make sure you get that. So what remains then, if they have 64 left in their inventory, and they're using the FIFO, the first in were the ones that first one out. So the first ones in were the first ones out. That means all the oldest ones are gone and all the newest ones are what remain, right? So if that's the case, the ones January 1st are gone. The ones on February are probably also gone. We'll come back to that. But that means the most recent ones I put in are what remains. So we know that on June 8th, there was 25 units put in. Those were $135. Sorry for my bad math with my finger. And so that's 35. There was 64 remaining, right? So there was another 30 put in on April 16th. So there was 30. And this thing is not working, times 146. And so how many does that equal? 55, right? So that means I need 9 more. So from February to 20, there was 9 more that were still there from what didn't sell. So those were 118 each. So in this case, the 35 was worth 3,000. Gosh, this is going to be hard. 375. And the 30 at 146 was 4,380. And then the 9 times 118 was $1,062. That gives us a total of $8,817 in ending inventory for that one. So that's using FIFO. First in, first out. So the ones that were the oldest were the first ones gone. Now, if I'm going to calculate using LIFO, the same one, then that means the last ones in were the first ones out again. So the newest ones are the first ones I sold. So that means these two are probably both gone, right? And so what remains is what was the oldest in the inventory, because those were put in first, but I didn't sell the ones that were put in first. I sold the ones that were put in last. So that means I have 40 of those 64 that remain at 125. And then 32, well, I don't need all 32, right? I need to make 64, I need what? 24, right? So 24 of those ones that were put in on February 20th are still there. So my dollar value on each of these is 5,000 for that one. And then this one was $2,832. And that equals $7,832. So that's how much was in ending inventory using that method. I apologize, those of you who are watching this video replayed, I just did the last method, which was to first add up all of these that came to 127, and then add up all these, it came to 16,531. And that was the average cost method. I would divide the total value of my inventory by the number of units in my inventory. That came out to $130.17 per unit. Multiplied by 64 came out to $8,330.88. So that is the average cost method of inventory. So does anybody have any questions on any of these? Are you guys good?
Yes, Professor.
Yes.
Trying to figure out, says I have 5 people, but I'm only, I guess, oh, I'm on there twice. Hello, okay.